Trump didn't waste any time bringing back tariffs in his second term.
The tariffs, they're all set. They go into effect tomorrow.
But compared to his first term, this new wave has been on a whole different scale, targeting nearly every country, with some hit harder than others. It's already set off a full-blown trade war and even triggered significant market turmoil along the way. So let's break it all down: the tariff situation so far, the arguments on both sides, and how it's rippled across the economy and markets. Now, Trump is no stranger to tariffs. His first term saw a trade war, mainly with China, but plenty of other countries got caught in the crossfire. And it started in 2018 with steep tariffs on steel, aluminum, solar panels, and washing machines, and kept escalating into a sweeping campaign that triggered retaliation from China, the EU, Canada, and others. The goal was supposedly to protect American industries and fix trade imbalances. And now, fast forward to this year, Trump picked up right where he left off with a fresh round of tariffs.
Oh, I think the tariffs are going to be the greatest thing we've ever done as a country.
The new wave began on February 1st. Trump signed an executive order hitting all Chinese imports with a 10% tariff and slapping a 25% tariffs on goods from Mexico and Canada. He tied it to national security, citing border control and drug trafficking. But 2 days later, on February 3rd, he paused the tariffs on Mexico and Canada for 30 days to allow negotiations. China, however, didn't get that buffer, and the 10% tariff went live on February 4th, and Beijing hit back almost immediately with new tariffs of their own. On February 10th, Trump raised the pressure. He bumped aluminum tariffs from 10% to 25% and reimposed steel tariffs on countries that had been exempt during his first term. Then, on February 13th, he introduced the idea of reciprocal tariffs. Now, note that this isn't the traditional definition of matching tariffs, but instead based on its own formula, which supposedly calculates the rate necessary to force the bilateral trade deficit with a specific country to zero. And that's assuming the deficits stem from unfair practices. By March 4th, those earlier threats turned into action. The initial tariffs Trump announced in early February finally took effect: 25% on goods from Canada and Mexico, and a new 20% rate on imports from China. That same day, all three countries announced plans to retaliate.
This is a very dumb thing to do.
China targeted U.S. farm exports with new duties, which officially kicked in on March 10th. All of this was building toward what Trump dubbed
Liberation Day.
On April 2nd, he launched the full reciprocal tariff policy he'd promised back in February. Around 90 countries that ran trade surpluses with the US, meaning they sold more to America than they bought, got hit with steep new tariffs, some going as high as 49%. Countries outside that list still got a 10% across-the-board tariff. The markets reacted immediately and violently. Global stocks plunged. The 2 days ending April 4th were particularly brutal, where billions, potentially trillions in market value evaporated. But it wasn't just stocks. US Treasury bond yields also rose sharply, even as stocks cratered, which is an unusual opposite reaction. Normally, investors flock to treasuries during sell-offs, which pushes yields down. Therefore, rising yields suggest that investors were just spooked by US assets altogether, perhaps fearing a US economic fallout or instability. And crypto wasn't spared either. Bitcoin slipped below 75,000 for the first time this year. April 9th was the official rollout date for the new tariffs. The tariffs kicked in just after midnight, but within hours, due to the market turmoil and faltering bond market, Trump announced a 90-day suspension on most of the new country-specific rates, except for the 10% baseline, which stayed. And that unexpected pause gave the markets some breathing room, and stocks and crypto rebounded, with the S&P 500 having one of its best days in decades. China, however, wasn't spared. In fact, Trump doubled down. He raised their import taxes to 125%. Combined with the previous 20%, that brought the total tariff burden on Chinese goods to 145%. China retaliated with a 125% tariff, but this time they made it clear they wouldn't respond to any further tariff hikes, and Trump also hinted that this round of back and forth might finally be winding down. At this point, you might be wondering, what are these tariffs even meant to achieve? Well, Trump's main argument is that other countries have been taking advantage of the US for years, selling more to America than they buy, while also putting up barriers that make it harder for US companies to compete. The claim is that American businesses can't compete on a level playing field when other countries protect their own markets but expect free access to the US. Trump's administration also claims the trade deficit itself is a threat. The idea is that the US buys more than it sells because foreign goods are cheaper, but that comes at the cost of domestic jobs and industrial strength. Tariffs, in their view, are a tool to push companies to build and produce more inside the US. One of the more controversial arguments behind Trump's tariffs comes from Stephen Moran, Trump's top economic advisor, and it centers on the US dollar as the global reserve currency. His point is that because the rest of the world uses dollars to save and trade, it keeps the dollar too strong. And when the dollar is strong, American goods become more expensive abroad, while imports feel cheap in the US. That, he argues, has hollowed out US manufacturing and pushed the trade deficit even higher. Stephen argues the US is propping up a global system providing both the dollar and military protection, and other countries have been riding that wave without helping cover the costs. He says it's time for burden sharing, whether that's accepting US tariffs without retaliating.
I did a 90-day pause for the people that didn't retaliate.
Buying more American goods, or even writing checks to the US Treasury. However, critics are quick to point out the inherent contradictions in using tariffs for the administration's purported goals simultaneously. Can tariffs maximize revenue if they aim to drastically reduce imports? Can they be temporary negotiating tools if they're meant to permanently reshape industries? And that's just the tip of the iceberg. Economists push back hard on the basic mechanics of the plan. One common argument is that tariffs are just taxes on imports, which get paid by American companies and consumers, not foreign governments. These costs are then passed down, hitting the lower income households the hardest as they depend more on cheaper imported goods. Critics also question whether tariffs actually bring jobs back. A recent study from MIT, Harvard, the World Bank, and others found that Trump's first-term tariffs had no meaningful impact on US employment, even though they did boost sales or employment in protected industries, but these were often offset by job losses elsewhere. And then there's the question of certainty. If businesses think tariffs might disappear in a few months, they're unlikely to make big long-term investments like reshoring. Instead, they'll just raise prices or move their supply chains to other countries not hit by tariffs, which in itself is a costly and complex process. And lastly, to counter Stephen's theory, critics point out the US has what former French President Valéry called an exorbitant privilege. Because the dollar is the global reserve currency, the US gets to borrow in its own currency, print what the world saves in, and run large deficits without the usual consequences. And asking others to pay into a system that already gives America such an advantage makes no sense. We've seen how the markets reacted immediately, but what about what's still ahead? If this pattern of sudden tariff announcements, retaliation, and policy reversals continues, expect more volatility. And it's not just the tariffs themselves that cause damage, but also the uncertainty it brings, which is unwelcome to any investor of risk assets like crypto. Plus, we've seen this before, back when major tariff headlines rattled markets during Trump's first term. These headlines triggered sharp sell-offs in the S&P 500. The same dynamics seem amplified now. So while the market did catch a breather after the temporary 90-day tariff pause, that window is quickly closing on July 9th. And more drama then could easily spook investors again. Finally, a more fringe theory suggests that tariffs are just a ploy to lower bond yields, making refinancing US debt cheaper. But this seems questionable since bond yields actually rose during the recent panic. And those are the major developments so far. The 90-day window is closing fast, and striking that many complex trade deals in such a short time frame, especially with dozens of countries involved, seems ambitious or unrealistic. So, what do you think Trump will do next? Drop your thoughts in the comments below.